The moment many have been anticipating is finally here. Asian trading desks opened only hours ago, and the result could not be clearer. The banks lost control. Last Friday, they unloaded billions in synthetic contracts in a last-ditch effort to shove silver below the critical 65 threshold. That level wasn't just technical, it was psychological. They needed to crush sentiment before the new week began. They failed. When markets opened in Tokyo and Sydney, silver didn't collapse. It surged. Prices jumped higher and held decisively above $67. This wasn't a routine fluctuation. It was a statement, a line in the sand. Friday's sell-off attempt appears to have been the final round in the chamber for the bullion banks. The market called their bluff. This is no longer speculation about a potential squeeze. This is the opening phase of a financial confrontation that threatens the very foundation of the paper pricing system. To understand why this Monday open is so damaging for J.P. Morgan and the swap dealers, you have to understand their exposure. These institutions are heavily short. They profit only if prices fall. Every cent silver trades above their short entry costs them enormous sums in additional margin. By opening above $67, the market has dragged them into maximum pain territory. They are now deeply underwater. Under normal circumstances, they would respond by flooding the market with more paper to force prices lower. But that option is gone. Liquidity has dried up. Selling more risks, triggering a stampede of buyers. Buying to cover is even worse. It could send prices straight to $75 in a heartbeat. They are frozen, trapped. There is no clean exit. The stability you see on the chart is not calm. It's tension. It's the pause before forced liquidation. While banks stare at screens full of red numbers, the physical economy is waking up to a much harsher reality. Industrial buyers don't trade derivatives. They need metal. Companies like Tesla consume real silver, not contracts. A typical electric vehicle uses tens of grams of silver, and newer models require even more. With prices elevated and inventories depleted, procurement teams are realizing that just-in-time supply chains are no longer viable. Quietly, off-exchange deals are being struck directly between miners and manufacturers. Metal is being diverted before it ever reaches traditional vaults. This shadow demand is tightening supply even further. When executives realize they can't secure silver for solar panels or electronics, they won't hesitate. They won't just buy metal, they'll buy the source. Mines themselves become strategic assets. This industrial scramble is the fuel that can propel silver from $70 toward $100. The real engine behind this move isn't in New York or London, it's in Asia. The Shanghai Gold Exchange opened strong, and once again the premium on silver expanded. That means silver is trading significantly higher in China than in Western markets. This price gap creates a powerful pull. Metal flows east, bars leave Western vaults and head to where they're valued more. This arbitrage is bleeding the LBMA system at an unprecedented pace. The West suppresses prices to defend the dollar. The East uses those prices to accumulate real assets. It is a massive wealth transfer unfolding in real time. For decades, high-frequency trading algorithms have dominated price action, selling automatically at predefined resistance levels. Today, those systems are malfunctioning. Sell orders are firing, and nothing is happening. Price refuses to fall. This is algorithmic breakdown. And when these systems recognize that selling no longer works, they are programmed to reverse. Shorts become longs. When that switch flips, possibly within hours or days, the buying won't be emotional or discretionary. It will be mechanical and relentless. The same machines that suppressed silver for years may soon be the ones launching it higher. Look at the screen and you'll see $67 silver. Try to buy it. Dealers quote much higher prices. Premiums are exploding. Delivery times are stretching. This gap between paper price and physical reality is a classic signal of a failing monetary structure. On paper, exchanges claim abundance. In the real world, supply is vanishing. This divergence cannot persist. Eventually, the paper system must give way. When it does, the adjustment won't be gradual. It will be abrupt. Cash settlement. Force majeure clauses and contract rewrites become real possibilities. At that point, holding a paper claim doesn't mean owning silver, it means owning legal risk. Technically, the setup is primed for a gamma squeeze. Call options are stacked at $70 and $75. As price approaches those levels, option writers are forced to hedge by buying futures. That buying pushes prices higher, triggering more hedging. It's a feedback loop. Mathematical, not emotional. Friday lit the fuse. Monday added the fuel. $70 is the ignition. Market psychology has shifted. For years, silver investors sold into every rally, conditioned by repeated failures. That behavior is gone. Selling pressure has dried up. The silver squeeze narrative has moved from fringe theory to mainstream strategy. Retail investors who watched crypto explode are scanning for the next asymmetric opportunity. Silver is small, thinly traded, and structurally constrained. When mass participation arrives, and it's beginning, the market simply cannot absorb the demand. Picture Niagara Falls forced through a garden hose. Something breaks. If silver reaches $100, multiple major financial institutions face solvency issues. Their short liabilities could overwhelm their capital buffers. That's why resistance has been so fierce. That's why coverage is minimal. This isn't about profit anymore. It's about survival. If control over silver is lost, pressure spills into gold, then bonds, then the dollar itself. Silver is the keystone, a small component that supports the entire structure. Meanwhile, geopolitical currents reinforce the move. BRICS nations are actively reducing reliance on the dollar and building trade frameworks backed by real assets. Silver is central to that strategy. Physical accumulation offers insulation against fiat instability. The East holds metal, the West holds paper. History tells us how that ends. The shortage is cascading. Mines felt it first, then refiners, then mints. Now manufacturers are next. The U.S. mint is already constrained. Private mints are overloaded. Eventually, factories will feel it. Industrial demand doesn't disappear when prices rise. It's inelastic. Devices cannot be built without silver. At some point, prices must rise high enough to coax supply from hoards, jewelry, and scrap. That price is not $67. It's far higher. Notice what's missing from today's headlines. Financial media discusses stocks and rates, not silver at record levels. Silence isn't accidental. Attention brings participation, and participation brings instability. They ignore what they fear. Be prepared for rule changes. If silver spikes sharply, trading halts, margin hikes, or exchange interventions are possible. We've seen it before, but this time, physical demand is stronger than paper control. Shut down the exchange, and trade simply migrates elsewhere. Price discovery will continue, with or without permission. If 6/7 holds, there is little historical resistance above. The market enters open territory. Models suggest a fast move to 75, consolidation, then acceleration toward $100. That's where public frenzy begins. Taxi drivers talk, relatives ask questions. We're not there yet. This is still the early phase. Monday arrived. The collapse didn't happen. The price held. The thesis remains intact. Waiting for a pullback may mean missing the move entirely. Momentum has shifted. Wealth is changing hands in real time. The banks bet against fundamentals. Fundamentals are winning. Hold steady, ignore the noise, watch the gap. The ride has only just begun.